My guest today has spent decades decoding the Indian economy, from the corridors of policy to the front lines of markets as well. Samiran Chakraborty is one of the most respected macro voices in the country, known for calling it as he sees it, with rigor and rare clarity. From the RBI's rate path to India's balance of payment, from the inflation threat lurking in our monsoon clouds to the echoes of 2013 that some are now beginning to hear again. There's no one better to make sense of where India stands today. Samiran, welcome to the interview. Thank you so much for your time today. Samiran, the big question on everyone's mind: what will happen to India's growth trajectory with so many overhangs at place right now? Is 6.5% to 7% realistic, or are we flattering ourselves?
Thanks, Aisha, for having me and for those kind words. So before we get into understanding what are the headwinds to growth, and obviously there are a lot, there are two things I want to highlight, which in some sense is reducing the immediate impact on growth for India, which other countries are facing more. One is that a very tiny proportion, only 2% of our electricity production comes from natural gas. This is much higher for a lot of Asian countries, in excess of 30%. So that way, our electricity production is absolutely not impacted by this crisis. And second is that we are a petrol diesel exporter rather than an importer of these refined products, whereas most of Asian countries, they don't have that refining capacity and they're dependent on these imports. And in today's world, the scarcity for these refined products is much more than scarcity for the crude oil. So in a sense,
we're better off.
Most important things of power and mobility are not impacted at all in this crisis. Which is why, till now, if you look at most of these high-frequency growth indicators that we track, we are not yet seeing as much impact on that. And it has also given, till now, the scope to the government to not take policies which will directly affect growth and inflation. The government has more or less said that let the shock be absorbed in fiscal deficit and current account deficit, or in price variables, not on actual real economy. But now, since the conflict is lasting much longer than what the initial expectations were, there's bound to be some growth impact too. In fact, the actions that are being taken on petrol, diesel price hike, etc., they will have consequent impact on expenditure on other items that will also affect growth. And then there is this huge petrochemical channel. This is an input which goes into multiple industries. Whenever we will see that the input inventory of these industries, they come down, then we could see more growth impact, supply side growth impact coming from that. So what we have done is, for now, we have reduced our growth expectation by 50 basis points. We were initially thinking 7.1%. Now we're at 6.6% for FY27. But on a lighter note, it's also true that this happened in the cusp of FY26 and FY27. So part of the growth impact will be felt in FY26 itself. So that's also probably saving the FY27 number on the margin.
Okay. So that, of course, was a very quick SWOT analysis that you gave me. But let's come to the weakness bit of it. While power and mobility may be taken care of, but the fact that oil still remains at a very uncomfortable level, while it seems that there is a cap around 114 thereabouts, it's not easing off from that $100 per barrel mark for sure. We've already seen 2 price hikes, and maybe could be more in the offing to try and protect the health of OMCs. What when that impact gets translated into consumption patterns?
So just to give you a sense of numbers here, so every 5 rupee petrol diesel price hike, if you think that the overall expenditure on all items remains constant, means that households will have to cut back 0.2% of GDP consumption on all other items. And this is not even assuming that this petrol diesel price hike will get translated into price increases for other products, as well as the transportation cost goes up. So that can have a higher growth impact too, unless people are reducing their savings. That's possible in theory, But that's one growth headwind that we have to definitely be concerned about. The other growth headwind, as I was talking about, is through this petrochemical channel. There are multiple types of petrochemical products which goes into many downstream industries, from packaging to pipes to dyes to whole bunch of stuff, even medicines. So right now, we probably had the input inventory to cover for a few months. But as this war extends, there is a possibility that we might run out of that cheaper inventory and we have to buy it at a much higher price. Then you might see cut back on production because those sectors might not have the pricing power to pass on those increased prices. And then there is this effect that is going to come from this disruption in maritime traffic in itself that can affect our exports. So that will have second round effects too. And on top of everything is this very difficult to quantify effect which comes from uncertainty. Both for consumption as well as for investment activity. In such an uncertain world, you're bound to see some stalling of these activities. So that's where we think that the growth impact are coming through these multiple channels. As of now, as I said, we have put a 50 basis point cut, but this is an evolving situation and we have to see how things are progressing.
And where do you see the inflation trajectory headed, assuming that oil remains at these 106 to 114 kind of levels?
So quite a few assumptions involved, but one of the key assumptions is that we've taken the petrol diesel price hike assumption right now at 5 rupees. With that 5 rupee price assumption and with normal monsoon, so if you have that 5 rupee price assumption and a normal monsoon, then we are forecasting a 4.6 inflation average for FY27. So the sensitivity is that every 5 rupee petrol diesel price increase is about 25-30 basis points of additional inflation. And we have estimated that the El Nino effect could add on another 40 basis points. So that's where the upside risk comes from, that we could see inflation going above 5% also if both the risks materialize, that we see petrol price hike to be more than 5 rupees and the monsoon turns out to be a deficient one.
The other big headwind, other than oil prices and an elongated war, is the currency, Samiran. Now, like we were discussing earlier, two camps. One believes that the market should find its own rate and the rupee will settle down wherever it has to. We're seeing some estimates even talk about 100 to the dollar right now. What is it that should be done right now? What tools does the central bank have to try and resurrect or stall this fall that you're seeing on the currency?
So if you take a step back, the problem which predates the war is the lack of capital inflows, or rather outflows.
Yes.
The war has complicated matters by increasing the current account deficit. Like for us, we were pre-war thinking current account to be 0.6% of GDP. Now we are thinking that number to be 2% of GDP. So it's a significant impact that has come, which has complicated the policy challenge on the currency front. Let's face it that if our forecast is correct, that even FY27 will be a substantial BOP deficit year, then this will be the third consecutive years of BOP deficit, which we have never seen in the past. So in a BOP deficit year for the central bank to control the currency is that much more difficult. That's agreed. And that's where some people are suggesting that just let the currency go and let that self-equilibrating mechanism play. But unfortunately, in Indian context, there are certain challenges. One of the challenges is that a large part of our exports, in fact, majority of our exports are in the form of re-exports. We import crude oil, export refined products. We import yarn, export textiles. We import gold, export gems and jewelry. In those cases, the exchange rate just becomes a pass-through. So you don't actually see the benefit of exchange rate depreciation on exports as much. Similarly, on investment side, we rarely see that investments flow in just because the currency is cheaper. Investments flow in only when they think the underlying asset is going to deliver returns, not just because of the currency part. In fact, currency depreciation can create an environment of risk rather than return in that sense. So that's where, if there is this perception of continuous depreciation without any support from the policymakers, then that depreciation begets depreciation, and this becomes a slippery slope. And that's where I think some policy intervention would happen at some point of time, both towards encouraging capital inflow as well as, to some extent, discouraging capital outflow, because that will have a more immediate effect. Encouraging capital inflows, unfortunately, takes time to work through the system. So it's hard to put numbers here that exactly where this rupee is going to settle down, but it is, at least I belong to the camp where I cannot suggest that that allow depreciation in an unlimited way and hope for the markets to find a self-correcting mechanism. I don't think it works in the Indian context.
How do you arrest the BOP situation? I mean, what tools would the government have to try and, buffer up the CAD? Because you don't have flows financing it right now.
Yeah, I mean, per se, the 2% of GDP current account deficit is not too large.
Sure.
In fact, some people will argue that a country at India's stage of development should actually run a slightly bigger current account. So we can't have too many very forceful measures to reduce the CAD, because that would have its own consequences on growth, etc. So the government has started doing it through the gold and silver route, which typically has been thought of as more unproductive in nature. We can delay those purchases for a few months. Now we are moving into the electronics product categories. The government has announced it for AC compressors. You could see more of that coming. The other important element, which historically the government has tried tweaking duties, is edible oils. We've seen those duties move up and down depending upon conditions. So that can be another area. I'm definitely not in the camp of trying to tweak with the LRS limits. In my view, that will not work as much because the LRS value is not, outflow value is not increasing year after year. It's been kind of flattish. So, and most of it is because of very essential things like travel and education. So there's not too much of a speculative element in it. So the problem really is that what to do with the capital account, because that's what predates the crisis. So we have to think of innovative solutions towards that. One sort of appreciation from this 3-month war period is that the bond inflows have been stickier than the equity inflows. And that's where we've been suggesting that getting India into more global bond indices could be one way of getting more sticky inflow into the country. And lastly, I think the market reaction, the INR move, vis-a-vis the actual BOP deficit, has been a bit too much. So there is obviously, quote unquote, this speculative element into markets as well. And that's where some of the measures could be just to ensure that this speculation is limited. We've seen some of that measures come in end of March. We could see a bit more of that also if the policymakers feel that this effect is again becoming stronger.
But tell me, what do you think that in a scenario like this, where I think the one word that can describe the state that we live in is just uncertainty. There is no word to describe it beyond this. What can the RBI do? Because many fear that, now you're going to see a rate hike come in, or at least the narrative may change. You think that's where we're headed?
So if you go to economic theory, the historical kind of wisdom has been that in uncertain times, you have to move slowly.
You hold fire.
you hold fire, you see how things are progressing, and then take action. Some people use this Chinese proverb to say that feel the stones while crossing the river. So that has been the standard practice. However, the change that I'm observing is that earlier these supply side shocks, these uncertain environment would probably come, whatever, once in a decade. Now we have got like 5 such shocks in 6 years. So when you have these repeated supply side shocks, the question is that can monetary policy really be very patient, or would it need to act? I'm not for a second suggesting that in the June meeting itself RBI will have to act, but it's just that looking through these supply side shocks is becoming that much more difficult for the central bank since the supply side shocks are becoming recurrent.
Interesting. So you don't think RBI will move as soon as June?
It looks unlikely to me because the last inflation print still is below their medium-term target. It's at 3.5, medium-term target is 4. So there is enough elbow room there. In fact, the RBI has now started focusing a bit more on the core inflation. They're giving the core inflation forecast also. So these energy shocks and the food price shock, they can, in a sense, look through those shocks and only focus on that core inflation number. So our sense is that the core inflation has to stay above 4.5 on a persistent basis for them to be worried about or utilizing the demand management tool that is the interest rate. Because otherwise, if it is just an energy shock or a food price shock, the interest rate tool is a very blunt tool to use.
Interesting. So if I just had to talk about, a couple of things here, how is it that you would describe in one word India's macro moment right now? One word or one line. This has to be very rapid.
Markets are diverging from macros.
Okay, very diplomatic answer. But yes, we got the point. RBI's next move, cut, hold, or surprise?
Neither cut nor hold, it's a hike. It's just the timing of this could be debatable. We think it's slightly more delayed, but yeah, I mean, cut looks very difficult now.
So hold for now.
Hold for now and then hike.
Single biggest risk to India's growth story in the next 12 months?
Well, how we absorb the energy shock, I think that's something that we have to see. That is the top of mind. But the area where, as an economist, I struggle is to understand this petrochemical supply chain issue. It's too complicated, but this is the unique part of this crisis. We've seen oil price shocks in the past, so we have some idea how the economy responds to it. But this is something that we haven't seen in the past. And just for understanding, chemicals and petrochemicals are 7% of India's GDP, and 27% of that is imported. So it's a big sector, and that is probably the kind of dark horse type of thing, if you want to call it, which is difficult to predict.
That reminds me, what do you have to say about this frenzy on gold?
Look, I mean, when other asset classes are not performing that well, then there's a natural bias for investors to find alternatives, and gold is one of them. And as we have seen, this is a global phenomenon in some sense. Whether it is Indian buying, Chinese buying, or central bank buying, all these things have contributed to.
In the first place.
So there is always this momentum chasing that happens in investments. In fact, I was looking at some World Gold Council data where it shows that the proportion of gold bars and coins in our import demand has gone up significantly. It's not anymore just jewelry demand, so to say. But at the same time, if you look at the total volume demanded on gold, it's actually down year over year. The gold import bill is higher more because of the price, not because of the volume.
Quantum.
So that also we need to keep in mind, that whatever restrictions we are making on gold imports, it is not earlier years when most of these restrictions used to come when the volume import was high. This time around, the restrictions are coming
to cap prices.
To cap the value imports.
Interesting. India's current account deficit, managing or a ticking clock?
I think we're okay. As I was saying, that 2% of GDP current account deficit is not something to fret about in a crisis year. It is not a structural problem as yet. However, the big caveat is that till now, the service exports have been fabulous. The kind of growth rate that they're clocking is very different from the narrative out there that AI is going to affect India's service exports. It's not seen in the data as yet. So that is the big risk to me on the current account, that this structural savior of the current account from the service exports, is that at some point of time going to be impacted by the AI, or does it have a way to push through the AI narrative and continue at that scale? I think that's the point which is underappreciated in the market. If it is current account deficit because of energy price shock or fertilizer price, etc., they are more up and down stories. Sometimes it will go up and sometimes it will come in. It's not a structural vulnerability for us.
It hasn't shown up until now, but do you fear that AI will have a much more long-lasting impact?
And this probably requires a discussion on its own because it's a complex subject. My bias is to think that if at all the risk is more towards the IT services and less towards the GCC part of it, and IT is like 180 billion, GCC is like 85, 90 billion. So that 85, 90 billion part can still continue to grow given new GCCs, etc. coming up. So if at all the risk is on that 180 billion, but what is interesting there in our analysis is that while the top companies are not doing that well, there's a new set of companies which are coming up, and that is probably keeping this number afloat. The growth rate is still continuing because of those newer companies coming in, and that's why, as I said, there's less impact as yet on the overall number.
One reform India must do this decade. No excuses.
Tough one. It's always difficult, but I would probably go into land. That's the area that we haven't touched at all. Labor, at least we have done something with it. So this is the one I believe should come in the next.
Next budget.
No, next big agenda. See, these are complicated political topics, so they take time to get approval of all the stakeholders. So if you start the process now, it will be, as you said, it's a decade thing. So it's going to take us several years to work through the system.
The Fed, do they have it under control amidst changing heads, transition?
So our house view is different from the market expectation. The market is expecting marginal Fed rate hike, but we think that at some point of time, Fed will actually have to cut because our sense is that the labor market is much softer than what the headline data is reflecting, and that at some point of time will force Fed's hand into cutting.
Okay. India at 8% GDP growth in our lifetime?
I mean, we just did 8% a year back.
Yeah.
So it's not, 8% is not that difficult for India. 7 should be easy. 8 is possible.
Okay. Samiran, thank you so much for your time. You've given us a lot to really think about today, and perhaps a few things to worry about too. But if there's one takeaway from today's conversation, it's that India's macro story is neither as clean as the optimists believe, nor as fragile as the pessimists fear as well. It is, as always, a work in progress, and having sharp minds like Samiran Chakraborty, tracking it closely, is exactly what the moment demands. Samiran, thank you so much for your time today.
Thank you, Aisha.